Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So the two most popular videos on this channel are all about calculating intrinsic value. In one of those videos, we went through Phil Town's margin of safety method, and in the other video, we went through Mona Scribry's discounted cash flow that he wrote about in the Dundo Investor. Now, one of the things I always get asked in the comment section of both of those videos is to go through some more real life examples of calculating intrinsic value for a company. So in this video, we're going to be walking through Facebook, do a full intrinsic value assessment, and arrive on what I think is an appropriate price to pay for Facebook, considering that we always want a margin of safety in our investment. So certainly don't take this price as investment advice or anything like that. It's purely just for learning purposes, but that is the plan for today's video. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been sponsoring the channel for several months at this point, and they have been my personal broker of choice for making all of my investments over in the US as a New Zealander. Now, I originally switched across to Hatch basically because of fees. They have much lower fees than what I was paying at one of the big banks, where I was paying $90 a trade. I can now do that exact same trade for $3 in Hatch. Now, they also have far more attractive foreign exchange in my experience than many of the alternatives, and overall it's really attractive for investors who are looking to basically minimize fees when they're making their US investments. Now, fees aside, Hatch also have a really modern and easy to use investment platform. Anytime that I have had a question, the Hatch team have been extremely helpful for figuring out any problems that I might have. And they also have a series of really useful blog articles, of which I have been writing a few recently. So if you're interested in checking out Hatch, you will need to go to the link hatch.as/investingwithtom. If you sign up and make a new account and deposit 100 New Zealand dollars into that account, you will get basically a free $20 top up in order to get started investing with a little bit more money. Okay, so we're over at the computer now, and the method we're going to be using today to calculate the intrinsic value of Facebook is something called a discounted cash flow. Now, this is something I've made videos on in the past, and it's a concept that I talk about fairly frequently in my videos. Now, I think it's important to first understand what a discounted cash flow is trying to do. And basically, what a discounted cash flow is looking at is it's projecting out the future cash that a business will produce and then discounting that back to today. So when I say it's discounting it back to today, basically what that means is if I receive cash today, that is much more valuable than receiving the same amount of cash in 5 or 10 years' time. If I receive cash today, I can go ahead and invest that in other opportunities and grow it. Whereas if I have to wait around for 5 or 10 years to receive that cash, it's not as valuable. So what I've put together here is a graph just kind of showing that visually. Basically, this is the present value of each year's cash flow for a business that produces $1 in cash flows per year. So I've discounted that back at a 10% discount rate. And basically what you'll see is if I receive that money today in year 0, then that dollar is worth $1 to me today in present value because I'm getting that today. Whereas if I don't receive that dollar for a year, it's worth a little bit less than $1. If I don't receive it for 2 years, it's worth a little bit less again. And if I go right through to year 10, if I don't receive $1 until year 10, that's really only worth about 40 cents to me today because of the time value of money. So this is an analysis we're going to do for Facebook. Obviously, Facebook is a growing business, so it's not going to earn $1 per year. We're going to hopefully get some growth out into the future, but nonetheless, really high kind of 10 years out cash flows will be discounted back in order to arrive at a present value today. Okay, so let's jump over to the other tab and start to run some of the numbers for Facebook. Now, another thing I should say before we get into actually putting some of these values in is that you really do need to understand the business of Facebook before you go through this analysis. It's really, really easy to put some numbers into a calculator and get a figure out, but it is important to have an understanding of the future trajectory of the business. Make sure that you're confident in the growth rates of the company that you're going to assume out into the future, because putting these numbers into a spreadsheet can sometimes give a bit of a false sense of security, a false sense of precision. So make sure you do research on the business, but assuming you've done all of that, basically these cells in grey are all the pieces of information that we're going to need in order to calculate the intrinsic value of Facebook. Now through this discounted cash flow, we have sort of 10 cash flow kind of events. So we have 10 years of annual free cash flow coming out of the business. And then we actually have a second cash flow event in year 10, which is when we're going to hypothetically say that we sell the business. So in year 10, you'll see two numbers there, and all of those combined cash flows, all the annual cash flows on the business, plus selling it in year 10 will be discounted back to give us a present value. So we're going to go through, look at the current cash flows for the business of Facebook, make some estimates about how much that can grow out into the future, and then discount those cash flows back to today to get a present value and make some adjustments so that we can arrive at intrinsic value for the business and kind of understand what price we should be paying for the stock in the public markets. So firstly, I'm going to start with the year one free cash flow. So this is a really important one to get right. Now, the easiest way I find to track down a free cash flow number for most companies is just to Google the company name and then free cash flow history. And that will often take you to a website by the name of Macro Trends. So if I jump onto Macro Trends here for Facebook after Googling Facebook free cash flow history, then I'm going to see the last few years of free cash flow for Facebook. Now, the important thing to remember here is that we want to pick a year that is representative for the business. We don't want to pick a year that is abnormally high or abnormally low, because that can throw off our future projections. Because basically, if we assume that Facebook earns, say, $10 billion this year, that $10 billion is going to be the base number that we grow in our discounted cash flow. So if we use a really high number or a really low number, that can give us some kind of wacky figures in our intrinsic value analysis. So in this case, I'm just going to use last year's free cash flow. Over the past few years, we've had some increases, we've had some decreases, but if we put that in sort of graph form, you'll see that largely it has continued to follow this kind of nice growth trajectory for Facebook. So in my opinion, that 21.2 billion in the last year is probably fairly representative. So that's the number I'm going to put into my year one free cash flow in our spreadsheet here. Now, next thing I'm going to need to do is we're going to have to look at growing that free cash flow out into the future. So in order to do that, I'm going to need some growth rates, and I'm going to use a couple of resources here. So one resource that I actually find really, really valuable is actually Phil Town's Rule 1 Toolbox. Now, you can get a free trial of this. I have no affiliation with you signing up to this website or anything like that. You can get a free trial. I guess you can get multiple depending on how many email addresses you've got. But this website is probably the best one I've found for giving you some background on the growth of a particular company. So if I pull up Facebook here, you'll see the compounded growth rate for book value per share and dividends, earnings per share, operating cash flow per share, sales growth, and you'll see that for the last 7 years, the last 5 years, the last 3 years, and the last 1 year, and these are all compounded numbers. So if we look at the sales growth rate for Facebook, for example, over the last 7 years, it's grown at 49% per year compounded. That's what this table is telling me. And what you'll notice is that over time, the growth of Facebook has definitely slowed down, but it is still growing at a phenomenal rate. So this can be useful to kind of look out the rearview mirror of the car, I suppose, and get an understanding of what the business has done so far. We then need to factor that in with our research of what the business is currently doing and the growth prospects that we think the business has, and then we can start to understand or make an estimate of what we think Facebook will do out into the future. So it looks like Facebook is getting down to about 20% per year growth, give or take a little bit in the past year. In the past 3, even 5 and 7 years, it's grown much, much faster than that. But typically, I like to be conservative and use, a slightly lower growth rate than what it's achieved in the past. The law of large numbers tells us that the growth of Facebook will slow down over time. Now, the other number that I'm going to sort of cross-reference this with is on Yahoo Finance. So if I pull up Facebook on Yahoo Finance, they have this page called Analysis. And if I go to Analysis, down the bottom, it will give me the analysts' estimates of their growth rate out into the future. Now, we saw from their historic growth that they've been growing around 20% per year for a long period of time, even more than 20% per year. If we look at analyst expectations, we see that they expect Facebook to grow about 21.5% per year over the next 5 years. So I'm going to be slightly more conservative with that and going to use around 20% per year. That is still a fairly high growth rate, so you're going to want to have a lot of confidence that Facebook can actually achieve that, but that's going to be a useful starting point. Now, the next thing we're going to have to do is look at growth rates from years 6 to 10. I always like to be more conservative here, so I'm going to use, say, 10%. Again, this is going to need to be based off the research that you've done on the company, but that's a place that I am comfortable going with for Facebook based off some of the work that I've done. Now the discount rate, I'm going to use 10%. That's a figure that I've basically plucked from owners per buy, and the terminal value multiple of free cash flow I'm going to use is 15. That is also a number I've plucked from owners per buy. So basically what that means is we're discounting our cash flows back at 10% per year. That's about the return we're going to expect to make if we were to buy Facebook at a fair value and be exactly right on our growth rates. We are going to search for a margin of safety, but that's going to be the starting point. And the terminal value range that Owners per buy likes to use is anywhere from 10 to 15 times free cash flow. So Facebook is definitely at the upper end of businesses in terms of their quality and in terms of the growth rates they're still achieving. So I'm going to max that out at kind of the 15 times free cash flow for what we could theoretically sell the business for in year 10. Okay, the next input we have is net cash or net debt. So when we buy a business, we don't just get the earnings engine of the company, we also inherit their balance sheet. So if they've got any debt or any cash, or a combination of both, we need to account for that. So easiest place I find to go to do that is back over to Yahoo Finance. If I go to Yahoo Finance and look at statistics, it should give me some basic balance sheet info. So if I scroll down to the balance sheet, this is going to tell me that Facebook have 58.24 billion in cash and they have 11 billion in debt. So to calculate the net cash, that's just going to be the cash minus the debt basically. So if I go back into Excel and type in 58 minus 11, that's going to give me about $47 billion in net cash. Now I'm just going to put in the stock ticker FB. And that overall gives us a present value of future cash flows of 660 billion. So that's our 10 years of cash flows plus selling the company in year 10. We actually have a slightly higher intrinsic value for that because we also have about $47 billion of net cash sitting in the business. So overall, we get an intrinsic value for the overall company of Facebook of a little over $700 billion, assuming that we can achieve those growth rates. Now the next thing to do is convert that over to a nice per share number and also look at getting a margin of safety. So as value investors, we basically never pay the full $700 billion for the company. We search for margin of safety so that if Facebook can't achieve that 20% growth in years 1 to 5 or the 10% growth in years 6 to 10, we have some protection from downside and we can still get a reasonable return on our money. So we're obviously not buying the entire business of Facebook all in one hit, even though that is the way we should think about it in terms of valuation. We are buying shares in Facebook. So let's divide this 708 billion by the number of shares. Again, if I go back to Yahoo Finance, that should be able to give me the figures here. And under share statistics, I have shares outstanding of 2.4 billion. So I'm going to put that over in my spreadsheet here, and everything is in billions, so that'll just be 2.4. And that tells me that the per share intrinsic value is around $295 per share for Facebook. If we want to get a margin of safety, a 30% margin of safety, we're going to be looking at a little over $200. And a 50% margin of safety, we're going to be looking at $147. So how's that stack up against the market price? Well, let's go and have a look. If I Google Facebook stock and let's just look over, say, the past year, currently the stock price is about $280. So it's in and around our intrinsic value of $295. So on the surface of things, it doesn't look super attractive. But our 30% margin of safety figure was $206 and our 50% margin of safety was about, say, $150. So let's have a look at how close Facebook has gotten to that in the last year. So we saw that through the kind of little crash or correction or whatever you want to call it through March, Facebook did actually get down to that point. So it traded under $200 for a reasonable period of time through March. and it got down to about that $140, $150 right at the bottom in March. So it just barely scraped our 50% margin of safety. And if you'd bought Facebook at that time, then you would have locked in a really, really attractive purchase price. So there you have it. That is an intrinsic value assessment for Facebook. I do hope you enjoyed that, and I hope it was relatively helpful in terms of understanding what you should be thinking about with each of the numbers that you put into that calculation. Now, it's really easy to put figures into a spreadsheet and just get an intrinsic value number out the bottom, but it's extremely important to understand the real future trajectory of the business. Make sure you've got your head around what the company actually does and where they're heading first, and then you can go in and do these valuations and make sure that you're paying an appropriate price for the company. So with all that said, if you did enjoy the video, please hit like and hit subscribe. You can watch some older videos over there. Hit subscribe over there if you haven't already, and I will see you in the next one. Cheers.